afternoon.
Well, as Jazzy said, my name is Sid Barnett, and I'm here to talk to you about insurance. I've been in the business for about 19 years. I'm a broker. That just means that I work with majority of the companies that do business here in the United States. My resident license is here in California, but I am licensed in many other states. And when business goes to other states, I just get the licenses in those states to accommodate. Today's presentation is just basically about life insurance. So the title of life insurance has life in there. And so most people associate that with, you pass away, your family gets a death benefit. But there's that component of the word life that's in the word life insurance that I kind of want to touch on and show you how to use life insurance while you're still living versus having to die.
Yes.
So, what is life insurance? So life insurance is a contract between an insurance policy holder, an insurer, or assurer, where the insurer promises to pay a designated beneficiary a sum of money upon the death of the insured person. So essentially, you pay a premium, you pass away, your beneficiary receives a lump sum amount of funds, and that's income tax free.
Ooh, say that part one more time.
The very last part, I'll just run it back.
Yes.
So you pay a premium, you pass away, your named beneficiary receives a lump sum amount of funds that's income tax free.
I never knew that.
So just to expound on that, it avoids probate, so there is no court proceedings. You don't have to have a trust, you don't have to have a will set up. The contract of the life insurance, being that it has a beneficiary, it avoids that process. It's paid straight to you once they receive the death certificate and they do their review. That check is paid to the family. Very powerful.
Did not know that.
So what is insurance? Insurance is intended to reduce financial uncertainty and make accidental loss manageable. To sum it up, make one whole from the loss or damage of an insured person or property. So basically, you lose something gets damaged, insurance is designed to replace that. Now, it's basically here to mitigate the loss or mitigate the risk. So we don't know if something's going to happen, but it's just in place, but it's just in case it's a safety net there. So if we put all that together, essentially what you're doing is you're insuring your life so that, when you die, it's not if you die, it's when you die, your family will be taken care of and they won't be burdened with your loss. So what are the intended uses for life insurance? So traditional life insurance is going to be for final expenses of the deceased, which is your funeral costs, your burial costs, pay off debts of the deceased. So you may incur, some credit card debt, you may owe some people, and most likely, there's certain ways out of it, but a lot of times that stuff passes on to the family when you pass away. So life insurance can be used for that. Income replacement, let's say you have a family, the husband or the wife may be the breadwinner, that person passes away, there's going to be a serious impact on the family if that person doesn't come home from work one day. So income replacement, asset protection, we're talking about home ownership. You see how hard it is for us to actually obtain the title of home ownership. That's a process. Now let's just say you finally get to that point, however hard it is, and then something happens to you. You can lose it all in one day.
Mm-hmm.
Insurance is designed to protect that home or protect your property from being lost. Also, it can be used for, a lot of times, for college tuition for the children of the deceased. So that person's not able to save up for the college savings or even save up for retirement, and so there's an amount of funds that passes on to the beneficiaries to allow them to keep, maintaining life and then for their future as well. So based on what I just told you right there, it kind of sounds like die insurance to me. You die, you get the life, or your family gets the life insurance. So in this situation, you're not necessarily benefiting from the life insurance directly because you're not around to see it paid out. You have peace of mind knowing that the family's taken care of. But essentially, based on all those reasons, this is after you're gone. And so, I pose another question. How can I use my life insurance while I'm still living? And that's what I'm here today to talk about. Aside from those reasons. Now, life insurance 2.0. Protection if something happens to you physically that you don't actually die from. So there's a lot of instances now where maybe you get in an accident, maybe you get some type of illness, and you don't actually pass away from this illness. Traditionally, maybe you did die, from this illness. But now with medical advances, technology, people are living longer, supposedly. Statistically, they're saying that. And so a lot of times you're going to end up in a situation to where you still won't be able to use that life insurance because you didn't die in that event. God forbid that did happen to you. I mean, I'm sure you wouldn't want to die. Your family would much rather have you here. But the insurance does you no good in that situation. The new kind of life insurance will actually protect you if you become sick, injured, or ill. Second point, or the second use for the new life insurance, legacy building, wealth transfer. So this is essentially not just if you pass away, we're putting you in the ground. This is a way you can transfer wealth and create a legacy for generations to come by having life insurance. Another point, or case use, is tax mitigation. So reducing your tax liabilities, let's say in retirement or on your way up to retirement. So we'll get into that. A supplemental income stream. So most people aren't aware of these types of concepts that life insurance can be used for this, but there is a certain type of life insurance that you can use to mitigate taxes and as a supplemental income stream. Debt management. And so this comes into play sometimes with credit repair. I know a lot of people sometimes are trying to, pay down some things, or maybe you buy a home, you have a 30-year mortgage, but some people want to pay it off a lot quicker. So what they end up doing is they, make extra payments each month or bi-weekly or however they do it. We can use life insurance to achieve those same goals without loss of principal. So we'll get into that. Capital. Finding capital and self-funding. So we're also talking about home ownership. So you get your credit fixed, you go out, you look for the house, and now how are you going to come up with those funds to be able to put down on the property? Or maybe it's a investment portfolio. So you're trying to start your real estate portfolio, and maybe you're looking for funding, or it could be other things that you're looking for funding for. Essentially, right now there's a hot button label called self-banking, or become my own bank, or infinite banking. Very trendy right now.
Yeah.
That's life insurance can be used for that as well. And then lastly, wealth growth. So life insurance is not an investment, it's not a security. So by law or by definition, I can't sit here and say that it's an investment, but there's a way to use life insurance to increase your wealth and grow that wealth. So starting off with the first benefit, or the first point I meant, use case, insurance that you don't have to die to use. So I told you in some cases, people end up in a situation to where they become sick, injured, or ill, and they don't die from that instance, right? And so in that scenario, the life insurance won't necessarily be used, the traditional life insurance. The new type of life insurance gives you access to your insurance policy while you're still living if you become terminally ill, chronically ill, critically ill, or critically injured. So we'll start out with terminal. Doctor gives you 24 months or less to live. The insurance company is going to give you access to up to, depending on the carrier, 90% of your death benefit. So let's say, for example, you have $1 million policy, just to use a nice round number, large round number. That'll be $90,000 or $900,000 that you would have access to while still living, that you can use for an experimental treatment. Maybe it's some type of rare cancer, and you need to get an experimental treatment. That's $900,000 you can have access to. Maybe it's something that's not treatable, and you have a bucket list or a quality of life sort of thing. You just want to spend that time with the family, take some trips, do things that you've never done. before you pass away, go to Greece, right?
Go to Greece.
Or lastly, maybe you just want to tie up all the loose ends before you pass away so that the family's not burdened with all these decisions. So maybe paying off a mortgage, paying off the debts, making the funeral arrangements before you pass so that the family can just mourn, and then the remainder of that money goes to them after you pass away. The next living benefit is called chronic illness. Chronic illness is very similar to long-term care. Now, the statistic is 70% of people 65 and older at some point will have a long-term care situation, whether it's a temporary or a permanent long-term care situation. This benefit is not, by law, I cannot say it's the same as long-term care because the payouts are different, but the triggers are the same. So if you're unable to perform 2 out of 6 of the activities of daily living, which is eating, bathing, toileting, transferring, or continence, they're going to give you access to up to 2% of that death benefit per month, or 24% annually. So this money can be used to pay a caregiver. This money can be used to pay bills until you can get back on your feet and get back to work. Or maybe your health plan does not cover certain expenses. You can use this to pay medical expenses.
And you said this one was the long-term one?
This one's very similar to long-term care.
Okay.
So the triggers are the same, but the payouts different.
Gotcha. And you have to have 2?
2 out of 6 of the activities of daily living, eating, bathing, dressing, toileting, transferring, or continence, which is the same as long-term care. Now, the difference between them is long-term care is dollar for dollar. So if you have $1 million of long-term care, it's going to pay you out $1 million. With these benefits, they're accelerated death benefits, and so it pays you a portion, a percentage. So you won't get it dollar for dollar. And the other difference is long-term care is traditionally a reimbursement for a stay in a skilled nursing facility, a stay in a senior home, senior facility, or if you have a licensed, qualified caregiver to come to your home and take care of you. It's a reimbursement for only those reasons. Whereas this benefit, as long as you meet those triggers for a certain period of time, they're going to allow you to get that money for whatever you want. So it's not a reimbursement.
And do you have to be 65, or is it just for?
No. That's just to say statistically, that's when usually those events happen to you.
Gotcha.
But no, I mean, if it happens to you tomorrow, I mean, you're only in your 40s and you're in your 30s, you can use this benefit. The next benefit is going to be critical illness, critical injuries. So these are going to be things like ALS, cancer, blindness, cystic fibrosis, aplastic anemia, end-stage renal disease, motor neuron disease, major organ transplant, severe burns, traumatic brain injury, coma, or paralysis, and a few others depending on the state. But depending on the severity, the insurance company will also give you access to up to 90% of your death benefit while you're still living. And what I mean by severity, stage 4 cancer obviously is more severe than stage 1, so you'll get more access, or you'll get access to more money in a stage 4 cancer because it affects your mortality. So in a sense, what happens is you have that protection that you need while you're still living. The remainder of the funds would pay out to the family, just like a traditional life insurance policy, so that they have the protection that they need, when you're not around. So in actuality, this is kind of like having multiple policies in one, but it's on the chassis of a life insurance policy. And this only applies to California because it's very difficult to get things approved through the California Department of Insurance. But there's only a handful of companies that actually offer this type of benefit here in California. And the insurance companies don't charge you in addition to your life insurance premiums. They give you these benefits for free. So whereas I said like the chronic illness is separate from, or is different than long-term care. Long-term care you have to pay for. This particular policy, you don't have to pay for that benefit. And so really what this was, it was created so folks that don't have a lot of money, just the average everyday person, can afford to have some of those benefits, whereas long-term care is going to be more catered towards wealthier individuals that can afford to have a life insurance policy and a long-term care policy. So I pose a question because we're going to get into the next point of how you can use this. I mean, how many of us in the room are millionaires? Anyone?
In the spirit.
in the spirit. Well, I mean, that's exactly why we're here, you know, to learn some concepts, to be around other people and kind of look towards that goal. But I'm sure we all want to be millionaires, right?
Yes.
We would like to be, right?
Multi.
And then how many of us would also like our children, grandchildren, and great-grandchildren to be as well?
Yes.
And I'll add just other family members into that bucket as well. Well, you can do that with life insurance. This is part of the legacy play. So what you do is you turn a small sum into a tax-free larger sum. So what you do is you end up buying a large policy, right? Because here's the thing, statistically, if we're investing in something, let's say, or we go to a casino, right? There's no guarantee that we're going to win. There's no guarantee that we're going to get a rate of return on our money.
Mm-hmm.
But there is one guarantee in life that we are going to die, right? We don't know when we're going to die. We don't know how we're going to die, but we know that we will die at some point. So if you use that concept in mind, and many wealthy families have used this. I mean, the Rockefellers, I mean, the Vanderbilts, J.P. Morgan family, you know, all these different families have used this concept to pass wealth, to transfer wealth and legacy, because they understand that we are going to die at some point. So if I can put a little bit of money on my life now, so that at some point down the road, I die, I give my family a large sum, I'm going to pass that money to them income tax free. Now I don't have to give any money to Uncle Sam. Where if we do it the other way around, Uncle Sam is going to be waiting, you know, for their estate taxes, their gift taxes, and all these different things. So just to use it, a scenario, I'll use it on myself. One of the policies I have is $1 million policy, right? Pay about $100 a month for this policy. So it's a 30-year policy. So if I look at, you know, let's just take $100 times that by 12, I got $1,200 per year. Multiply that by 30, and, you know, I'm putting in $36,000 over that 30-year period. Now, if I die in that period of time, whether it's in the first year or it's in the 30th year, that's $1 million that goes to my family. But the most I'll ever put into that policy is $36,000. So I don't know any investment or any casino or anything, maybe Bitcoin or something like this. If you got in early, you can put in $36,000, you become a millionaire. But in this situation, you can do that with the life insurance. Now, there is a school of thought, and I'm with this school of thought, to say that you should not necessarily use life insurance as some type of investment, right? So I'm not saying don't do any other type of investing, don't do any other type of business, just do life insurance. What I'm saying is that if we look at it, if we were to put that same $100 into, let's say, a retirement fund, and we're getting a rate of return on that money each year compounding, $100 a month, $1,200 a year for 30 years, I would have to get a rate of 17.5%.
Which is not going to happen.
Consistently over that 30-year period of time in order to do the same $1 million in that investment. So, well, I'm not saying that it's not possible for you to do it. I'm saying that the life insurance is almost like a for sure hedge to whatever other investments you're going to be doing, and this is going to be something that is for sure going to be passed on to the beneficiaries along with everything else that you're doing. The average investor's rate of return is only, in a 401k, is only between 6 and 9% over the last 10 years. And so to try to achieve a 17.5%, now there's people out there that can do it, but the average person's not going to be able to do it. So you can see we're trying to become a millionaire or make your family millionaires is very easy with life insurance, but it's very difficult if you're just going to do it from scratch in investing. And just to cap it off, that transfer of wealth is tax-free. That's the main point that we want to emphasize there. And then, so I pose another question. How awesome would it be to pass millions to your heirs, allowing for future generations to gain a head start on life? That's the way to do it. I'll tell you a little story. I went to a convention of top producers for this particular insurance company I was working with in Vegas. And there was only, I think, about a few hundred of us there. And they had a course or a speaker come in from, I think he was from South Africa. He was Dutch, but he's from South Africa. And the module that they spoke about was legacy transfer using life insurance. And what he proceeded to tell us was how wealthy families, him included, it's a little known secret type of thing, where they use these policies to transfer wealth to their beneficiaries. The wealthy know how to keep money, they know how to make money, but they also know how to keep money. And so for them to use life insurance for that purpose, you'll hear out there financial planners, financial professionals say that life insurance is bad, it's a scam, don't do that. Maybe they'll say buy term, invest the rest, and do these different things.
Right.
Which, in a nutshell, I mean, it's true, but there's other aspects, and not everybody's situation is the same. And then also, too, there's a time and place for each of those vehicles or each of those concepts and strategies. It's not to say that only do life insurance, only do investing. What I'm saying is put this thing all together and be smart about it. You know, let's be efficient with it. And so what they showed in that thing is that for a scenario, maybe you have an older person, the grandfather or the father of a particular family who is in turn a grandfather. Let's say maybe he's 70 years old and maybe he's in good health, right? So he can get some life insurance. Maybe he has, I'll just say, 4 children. Those 4 children go ahead and put $1 million policy on grandpa, because grandpa, or on dad, because dad is healthy, he can get it, and he knows that, you know, I want to pass some wealth on to you guys, I'm going to pass away, we may as well put this on. The kids, they go ahead, maybe the premium is $2,000 a month. I mean, if I tell you guys that your insurance is going to be $2,000 a month, that might be a little overkill, and it may turn you off a little bit. But in this scenario, since they're doing it for a purpose, let's take those 4 kids, that's $500 a month. They're going to each pay $500 a month into this policy. So $2,000 a month, $24,000 a year, 10 years, that's $240,000. Let's say 20 years, you know, that's $480,000. So they essentially put $480,000 in there to basically get $1 million back, right? So again, I say, maybe you can invest in the stock market and get better numbers, right? But this is going to be a for sure bet, and you'll never pay in more than what you'll actually get back, just by the nature of it. And if we look at a 70-year-old person, mortality rates for a male is in our early 80s. For women, it's mid to late 80s. And so, based on mortality tables, I mean, maybe he'll live that 20 years. Maybe he'll outlive the 20 years. But if you do it, structure it correctly, you're going to get into a policy that actually builds on the cash value side, to where if you do end up paying in more, what's going to happen is your cash value is going to be pushed up and your death benefit is going to be pushed up. So there's never going to be a situation where you're actually losing money. It's just about thinking about these things a little bit different, and this is what they do in these wealthy circles, that they understand the loopholes and the benefits of how to manipulate and exploit certain things. So next topic, or next case use, is tax mitigation. So right now we're in the lowest tax environment that we've ever been in. This was starting with the last administration. So, I mean, love them or hate them, taxes went down during the Trump administration. Now, this is the lowest tax environment that we've ever been in our entire lifetimes. And there was something that was written into law at that time called the sunset provision. Is anybody familiar with the sunset provision? Okay, well, sunset provision expires in 2025, December 2025, and January 1st of 2026. Tax rates are due to revert back to at least what they were in 2017. So right now, for marginal incomes between $78,951 and $168,400, you would be in a 22% tax bracket with today's tax tables. The tax tables in 2017, $75,000, so the income threshold lowered, and between $75,901 and $153,100, that percentage is actually 25%. So there's going to be an increase at that point in time, and we don't have a crystal ball, but we have to assume that taxes are most likely going to go up and not go down. And
The 5%, 5 cent bread loaf.
yeah, there you go. And here's the thing, the new administration, although they are doing some things right now to try to help things out, they've already said that they want to increase taxes. They want to change, they want to repeal everything that, Trump put into office. And so we think that taxes may go up a lot sooner than 2026. Now with inflation and everything that's going on, maybe they hold off for a while and they keep things in place, but taxes are most likely going to go up. And so what we're essentially saying is pay those taxes now while they're on sale so that you don't have to pay taxes later at a much higher rate. I mean, if we look at in 1986, the tax rate was upwards of about 50% at the highest bracket. So not saying it's going to get back to 50%, but it's could very well get to that level or higher. And so if you're doing things like, let's say, a 401k, a traditional IRA, these are all qualified tax-deferred vehicles. You're not paying taxes on that money now because it's pre-tax dollars where you're going to get a reduction on your taxable income, but you're just postponing the inevitable. You're going to end up paying taxes at a higher percentage. So what you could do is you can use a life insurance policy. This would be a cash value-based life insurance policy, an index universal life policy that you could pay into with after-tax dollars, and then when you get your distributions from that policy, you would essentially take those out income tax-free. And that's how we're able to mitigate taxes. You can also convert what we call Roth conversions. You can convert some of your tax-deferred money now into tax-free money later by using either, let's say, a Roth IRA or what we call the Roth IRA alternative, which is the Index Universal Life Insurance Policy. So some of the benefits of the Roth IRA is that the Roth IRA, as long as you have that account for at least 5 years, they will allow you to take your distributions from that plan income tax free. However, it is a qualified account, and so it does have an age 59.5. So it's meant for retirement. So if you make any premature distributions from that plan before age 59.5, you will be penalized 10% by the IRS. There are contribution limitations on a Roth IRA. So the most you can put in, if you're under the age of 50, is $6,000 a year, so $500 a month, or $7,000 a year if you're 50 and above, which works out to be about $583 a month. So for some folks, that's not really a big deal. I mean, they're not putting that much in there anyway. But for other folks that may want to increase the amount that they have in retirement, or maybe you started late, that may be a hindrance to you in terms of putting in there. Now, if we all get to the point by various business endeavors that we do become millionaires or 100,000aires, another drawback of that Roth IRA is that there are income restrictions. So once you start to make a little bit too much, whether it's you file single or whether you file jointly, you will lose the ability to be able to contribute to these plans. The life insurance aspect of tax mitigation, you are able to avoid the age 59.5 rule, so you can take that money out whenever you need it. So it's flexible, no penalty. You don't report it to Uncle Sam once again, so you can take those distributions out tax-free. There are no contribution limitations. You can put as much in these plans as you would like, and that's how we later get into coming up with self-funding strategies and infinite banking. And then also, too, there are no income restrictions. So all levels of income earners can do this. Whether you make $25,000 a year or whether you make $100,000 a year, you can utilize this strategy. And then the tax-free distributions that you get from these plans are taken through participating loans. So you're actually taking a loan from yourself, therefore it can't be taxed. And I'll get into how that participating loan is going to essentially benefit you when when we're talking about taking income from these plans. So the last couple points for the life insurance 2.0 is the income stream. So we talked about the income stream. So there are ways and use cases for this. I use this for my clients when we're talking about retirement. So, I'm 40 years old now, so I'll just base it off myself. Let's just say I have another 25 years of working, just because that's an arbitrary age, 65. That's Medicare age. Also a Medicare advisor, and that's when you retire and you can get your health care for free if you've contributed into Social Security.
Or disability.
Or, disability, you actually can get your Social Security and your Medicare earlier if you end up on disability. You don't have to wait till 65. But we'll just use 65 as an arbitrary retirement age. So that gives me about 25 years of being able to, let's say, fund some retirement. So how it would work is I would essentially either put a lump sum into a policy, $50,000, $10,000, $100,000, whatever it is, or I could do it on a monthly basis. So what I usually use for a rule of thumb is I take a person's age, I multiply that by 10. In my case, that would be about $400. That would be a good baseline amount for me to contribute per month. I would put that into that account for the next, let's just say, 20 years on a monthly basis. And then once it comes time to retire, instead of a 401k or another fund, I would start taking withdrawals from this fund, right? And hopefully I would have some other things set up. 401k would be my tax-deferred side, right? This would be my tax-free side. And what we would do is we would use them as a supplement to each other. And how that can help you out is, let's say, for example, it's 2007, 2008 all over again. S&P lost 39, almost 40%. Right? So let's say you decided you wanted to retire in that particular year. Well, you're going to want to take a distribution, right? So let's say you take about 3 to 4% out, plus the market just lost 40%. You've essentially just lost half of your retirement income in one down year because you took a distribution at the same time the market lost. And now that you're not working, you're in retirement, you are never going to be able to recover. So you just shaved off more than half of your retirement savings in terms of years. So now you're going to be in a situation to where either you're going to have to go back to work, you're going to have to live a life of squander where you're just, you have to really not do anything in retirement, kind of focus on your Social Security. Whereas if you have your tax-free bucket, what I would say is hey, client, let's take this money from your tax-free bucket until the market picks back up, because the market always corrects itself. Let's let it stabilize, get you back to at least level, or maybe even make some gains, and then we'll pull some money from that account. So let's just take it all from your tax-free side, and then what will happen is you're essentially able to control and ensure that you don't outlive your retirement, because we're able to choose which bucket we take it from. Now, just another point, going back to the tax bracket. So let's say your income now is $150,000, whether you're single or you file jointly. You're in that 22% tax bracket, right? Well, let's say in retirement from your 401k or your qualified account, you still get the same $150,000. So you're going to be in that 22% tax bracket. When the sunset provision expires, you're going to be in that 25% tax bracket. Well, if we have a tax-free bucket set up, what we could do is, this is another cool trick that we use, take $75,000 from your, let's say, your tax-deferred side. Let's take $75,000 from your tax-free side. Still the same $150,000, but now look what happened. You're only reporting $75,000 of that income, so you're paying taxes on less of your money, right? So you're paying less taxes on a smaller amount of your money. But now what we also did is we dropped you from a 22% tax bracket down to a 12% tax bracket by doing that. So now you're essentially paying taxes on less of your money, and you're paying at a lower rate. So by starting a tax-free bucket using life insurance, we're able to essentially mitigate your taxes, control your tax bracket, but also control and ensure that you will not outlive your retirement. Now, the next use case was the debt management aspect of it. And this could be, credit card debt. This could be a mortgage. Essentially, when you have credit cards, they have different interest rates, right? Your mortgage, if you get a 30-year, and let's say you refinance down to a 15-year, maybe you get a good interest rate, but at the same time, your payment's going to be higher because it's a smaller amount of years. The way we use this is, instead of making those full payments, let's say to a credit card or to the mortgage, we make that same payment into the life insurance policy. Same way. So maybe on credit cards, we're just paying the minimum. Maybe on a home, if you didn't refinance down to a 30-year, you keep the 30-year, you don't make extra payments. If you refinance to a 15-year, or you started with a 15-year, refinance out to a 30-year to bring that payment down. So we'll put that same amount that you would have contributed towards the mortgage or towards the credit card to pay it down, we'll put that into the insurance policy. Now after time, let's say your insurance or your credit card, we take the one with the highest limit. Based on us building that cash value and contributing to it, now we're going to go ahead and maybe we'll pay off that one with the highest limit. And then we'll just rinse, wash, and repeat that cycle until it's all paid down. But remember, and then let me use this example. With the house, maybe we go the full 15 years of accumulating it into that cash value account on that 15th year. Now we take that lump sum and we pay off the mortgage like you wanted to do anyway with the 15 year. Well, Sid, why would we do something like this? I mean, I'm letting these credit cards linger. I got the interest rate, it's going up on me. The house, I just paid it off in 15 years. I could have did that on my own by doing it this way. But here's the thing. When you pay off your credit cards with your own money from the bank, or you pay off your house with your own money from the bank, that principal is gone. That money is gone. Yeah, you're debt-free now. Your house is paid off. It's great. But you just lost that principal. When we do it from a life insurance policy, remember what I was saying before, is that we take participating loans from ourselves. So by taking a participating loan from ourselves, what's going to happen is, first scenario, we got $100,000 in the bank. We took out $20,000 to pay off the credit cards or the rest of the house. So now we only have $80,000, right? Any interest that's being applied to that money in the bank, less than 1%, unless you have a higher interest earning account. But let's say it's 10%. We know that's not possible. That 10% is going to be applied to only $80,000. If we do it in the life insurance policy by taking a participating loan, we took out the 20, we paid down those things, but that 10% is going to be applied to the full $100,000.
Shit.
So you're essentially peeling off funds to essentially, well, in this one you're paying down debt, but you're still earning money on the money that you used, and so you don't have any loss of principal. If we use it for a capital and self-funding aspect, so take out the debt, let's just say we took that money out to put 20% down, or in this program 1% down on the home. Well, now what we've done is we've just created a new asset. And if we're going to be renting it out, a new passive stream of income, but we're still making money by earning interest on the original principal. So that's how you're able to create wealth, grow wealth, find funding, right? Because here's the thing, if you're, let's say, for example, you purchase a home, you flip it, you sell it. Well, that money normally, that profit, maybe you put it in the bank until you find your next flip. You're not going to be earning any interest on that money. It's just going to be sitting there, but you have access to it, right? That's why people like to put money in the bank, for liquidity. Well, in these plans, it has to be the right plan, though, because not all of them are created the same. There are plans that we structure where they have early liquidity. So we're actually able to have access, just like a bank. Can't write checks to get the money, but within 24 to 48 hours of submitting the paperwork, we can get that wire to the account, so no problem. But essentially what we're able to do is we're able to let's say flip that home, put the profit into an account like this until the next big opportunity. We don't know if that's going to be next month, it may be a whole year. So why not earn some interest on that? And then some people may ask me, well, Sid, if we're taking a loan from ourselves, do we have to pay that loan back? Well, technically, you don't have to pay it back. It's in your best interest to pay it back, but let me show you how it works. I have a client that took a loan from herself to pay her taxes, right? The loan cost her 3.5%. I'll just call it 4% for easier math for me. This past year, she did 10.89% in this account. That was her credited interest. We'll call it 11% for easy math. Difference between the 11 and the 4 is 7%. So that 7% that she gained based on that performance, if she does not pay back the loan, it's going to start to replenish the loan. But what I tell clients is, let's say you are doing real estate and you are building a passive income portfolio. Well, instead of putting that passive income into the bank, just run it right back through your account. So now we're growing that account back to where it was.
Wow.
You're earning interest on it, and it's just a wash, rinse, and repeat type of situation. And then what ends up happening is your portfolio grows, and then your working capital grows at the same time, just by doing this strategy. And as a byproduct of this, these plans earn between, if we're looking at it historically, 6 to 8%. If we're looking at a 10-year look back, even in some cases a 20-year look back. What did I say the average investor is doing in a 401k is doing between 6 and 9%. So it's right in line with what the average investor is doing. S&P averages about 10%. So we're not too far off from the S&P, but here's the thing. Using these plans, you don't have any market risk. When the market goes down and it's negative, these are index-based strategies, so it is attached to an index, but there's a floor built into it. The floor is typically about 0%. So if the market does negative 20, you can't go below your 0%. So market goes up, you're up. Market goes negative, you're flat. Up, so it looks like a stair step. Whereas those people in the market down negative 20, it's back up, let's say 10. Well, they still have to make up ground, so they're at a negative 10 still. You start from where you left off, and that's why it looks like a stair step. So the fact that it's not quite in line with the S&P in terms of what you're able to get in the S&P, you have no market risk, right? So you don't have to worry about loss of principal or gains due to market downturns. We didn't even talk about the life insurance aspect of it. If you put in money, I'll use my mom for an example. She sold a home, profit was $190,000. She just retired. I put 150 of that into a policy like this. She's not trying to invest in real estate, but she was going to put it into a bank account. Her thing is she's in a travel club, so they take trips each year. She wants to be able to do 3 cruises a year.
Yes.
So we're going to take out $7,000 a year for her to have money for her trips. The policy still runs till she's age 120 based on the illustration. So that means she still has funds in there. By putting in that 150, it gave her, she has some health issues and she's a little bit older, and so her cost of insurance is a little higher. So it gave her about $274,000 based on the 150 that she put in.
Wow.
In a lot of cases, it'll double or 2.5 times your whatever you put in. So let's just call it maybe $300,000 if you put in $150,000. So you're getting a death benefit from it. In her case, the living benefit is what she was most concerned with because she already had life insurance. She wanted the chronic illness rider, which is like long-term care. So we got her protection from the market. We got her, we're going to get her a healthier rate of return than she would get in the bank. We gave her a death benefit, which is a legacy to me and my brother because we're the beneficiaries. We gave her the living benefit, which she wanted, which was the long-term care. And then we also gave her access, so there's liquidity just like a bank if she actually needs to get that money. And so we did that all with a life insurance plan, and that's where I'm saying that it's not the magic bullet, it's not the magic pill, but it's something that definitely should be incorporated into a person's strategy.
Question for you, Sid.
Yeah.
Is it, what you're speaking of right now, is there do a lot of people don't know about it, or is it something that you teach it right now? Or,
Well,
because I never heard of it.
it's not that people don't know about it, but there's 2 schools of thought on life insurance for these types of strategies.
Okay.
One school of thought is that it's a scam, don't do it, invest in the market. do this. You'll find that for financial professionals and financial advisors.
Mhm.
I'm not a financial advisor myself. I do retirement planning, but I do work with registered investment advisors, and so I have that experience too, and I have that exposure. And so the other school of thought are insurance people that'll say, yeah, this is the best thing since sliced bread. So both of them are biased,
Right.
and both of them have motives. This group is like, hey, if you're doing money over there, that means you're not doing money over here. And this group over here, which is the insurance guys, are saying, hey, well, I'm not licensed to do what they do over here, so I gotta get your money somehow, so this is my product. I'm in the middle to where I say, I incorporate both of these strategies.
Yeah, collaboration.
So my even my registered investment advisor, what I do is I bring the client to him, we do some retirement planning, I'll do some preliminary stuff, but we'll incorporate him, and then based on the client's risk profile, that's how we determine how to allocate, so we diversify. But what you gotta think about is that the banks and a lot of companies, we put our money in the bank, you know, we're doing the stock market, we're doing all these different things, they're actually investing in life insurance.
Yes.
Because it's a way to leverage
Yes.
and hedge your bet for your investment. Well, I don't want to call it a bet, but hedge your investment. And it's conservative and it's safe, because a lot of these index funds that they use are invested into bonds, which bonds are very safe, right? And so they're taking your money when you put it in the bank, they're lending it out to people, and then they're going ahead and they're investing in stuff like life insurance.
Right.
So why wouldn't we just cut the middleman out and do it ourselves?
Yeah.
Now the caveat is that life insurance is based on health, so you have to have a certain health level to be able to pass through underwriting, and so not everybody can take advantage of these strategies. But then there's other ways around that we use, and so it's not that it's off the table for those individuals. We just have to get creative. And to go back to your point, I've been in the business for 19 years. Started out doing what we call mortgage protection. It's selling a term plan for the size of somebody's mortgage loan, so that if they don't come home one day, the family can stay in the home. It pays off the mortgage, right? So I did that for a long time, but over the years, just exposure to different markets and different individuals, you kind of start thinking outside the box on how you can use these tools for different strategies. Like, they don't teach us these things. The carriers don't tell us,
Of course not.
use my policy to freaking buy a house, you know. We had, you know, this is me kind of coming up with it. So to answer your question, there are individuals right now, social media is trending with a lot of people that will talk about this type of stuff. A lot of people don't know about it because it's not what the intended use of life insurance was for. It's just ways that we kind of figured out how to use it for this particular thing. And then where I come into play is that I always do what's in, I call myself an insurance advisor, not an insurance agent. An agent to me is a salesperson. An advisor to me is a professional. And so if I'm looking at my client's best interest in mind, right, I'm trying to solve a problem, I need to be able to have some ideas or some solutions, right? And so it's not about one size fits all, this policy works for everybody or this strategy works for everybody. Whereas an agent, they have a product, they want to sell it to you, they're trying to get a commission, they don't really care.
Right.
What it is, they're going to sell you the company that gives them the most commission. Whereas me, there's companies in this space that offer products where I get less commission, but I know it's the best product. And the reason why I get paid less is because it actually benefits the client more. So the insurance company's like, hey, we got to pay somebody, and we're going to pay the client. But I'll still put them with it because I'm a professional, and it's about solving those problems and doing what's in the best interest for each individual. And so it's catching on now with social media, but a lot of stuff you'll see on social media, because I look at it myself too, and I'm like, I get calls when people see videos, but then sometimes I'll see the professionals on there, and they'll
Leave something out.
They're leaving things out because they need to make it sound like a hot thing, like, hey,
They're magnifying it,
yeah,
glorifying it.
use life insurance to become a millionaire. And it's like, well, I mean, yeah, you can, but it's not, it's no different than a 401k or anything like that. There's steps to it and it takes time. It does take time. I won't get into it too much right now, but there's also another opportunity to use the life insurance to grow wealth and stream of income, to where for certain individuals that make at least a minimum of $100,000, they're allowing them to do this strategy that we call, it's basically premium finance. So when we get finance or mortgages, right, or we take out loans for cars, why do we do that?
Because we don't have all the money up front.
We don't have the money up front, and we want the bigger house, right? We want the nicer car. I mean, here in California, we probably couldn't buy it if we wanted to, but let's just say we could afford it to pay out of pocket. It probably wouldn't be the one that we wanted, right? So we finance it. So this strategy is basically saying, why not finance your retirement or finance your wealth? And so what it is it's an injection from a third party, which in this case is the bank. They'll put a 2.5 to 3 to 1 ratio of funds into your account. So you put in 100,000, let's say, that means there's 300,000 going in there potentially. And what that allows you to do is amass a large amount earlier and take advantage of compounding interest and the time value of money a lot sooner. Whereas in a 401k, IRA, IRS guidelines do not allow you to put over a certain amount in there per year. And so even if you had the money, you couldn't actually throw as much in there as you would like to take advantage of that compounding interest. And so this strategy allows you to get almost like a match on your 401k, where the bank is essentially matching your funds at a higher ratio. But what happens is you're only contributing for 5 years. So instead of 5, 10, 15, 20, 25, 30 years of working, you're contributing to this plan, you're able to stuff all this money in over a 5-year period of time from yourself. The bank's going to contribute for 10 years. So it's a 10-year period of time that funds are going in this. And you're basically condensing a 20, 25-year period of time down to a 10-year period of time. And you're getting the same result by putting less in. But that strategy is used on the chassis of a life insurance policy, and so it's a pretty advanced strategy concept, but it is available out there, and a lot of people don't know about that particular strategy because traditional premium finance was only available to those that had a minimum net worth of $5 million, right? And you had to put up collateral, so you had to put up a house, you had to put up some type of property, and so for the average everyday person, we couldn't participate in that type of strategy. This strategy brings that to the average everyday person. The caveat is that you have to just make at least a minimum of 100,000, and the reason being is because since it's condensed down to a 5-year period of time that you're contributing, the contributions have to be higher, and most people, if you're not making at least 100,000, is going to be able to contribute on a level that's going to make sense to be able to do the strategy. So benefits to owning life insurance 2.0, you're going to get your family protection, asset protection, financial protection. It's a legacy builder. It's an income supplement. It helps you with cash flow. It's a tax-free vehicle. Protects you from bad markets, so downturns in the market like we're dealing with now. And it's also a wealth builder. So I pose this question. It's kind of rhetorical. Do I need life insurance?
Oh, yeah.
Absolutely, you do need life insurance. And aside from all these new things that I just gave you, how you can use life insurance, the basis of it is that GoFundMes, car washes, bake sales, hot plates, whatever it is that people do to fund.
Stop talking about my people, okay?
There you go.
Jesus, the unprepared.
Those things should not have to occur. So I just talked about getting $1 million policies and all this stuff, but you don't need to have $1 million policy. At minimum, you should have at least enough that your family's not burdened with the fact that they got to put you in the ground and cremate you however you want to get. So, a $25,000, $30,000, the average cost of a funeral is about $25,000 to $30,000. So you can get a policy for $25,000, $30,000 a whole life. That means it covers you for your whole life, and you can pay pennies on the dollars for that if you get it, at the right age. And that way, at least that basis is covered. And to me, I gave you a lot of advanced, topics, but foundation-wise, everyone should have life insurance if they can qualify for it at some level, just to ensure and not be selfish. Just an unselfish act of love that you make sure your family's not burdened when you pass away. Yeah. And just in closing, if there's any questions, I can answer any questions. But if not,
Hi. Hi, I'm Wayland, and I have a question. I'm one of those people that started late. Health issues. It's like they come at you, say, "Oh, you can pay this much," and then they come back and say, "We can't even underwrite you because high blood pressure, diabetes, whatever that is." What do you suggest for that person?
Well, here's the thing. So again, insurance advisor. I used the word broker earlier, but in our industry, it's not really a broker. But everyone knows what I mean when I say broker. The fact that I'm able to deal with majority of the carriers that do business, there are companies that do underwrite certain conditions, and so I have something for everyone. Okay. The most healthiest to the person who is uninsurable everywhere else. We have guaranteed issue policies for that particular individual. Now, the trade-off is that if you do get, let's say, a guaranteed issue policy, which means they don't ask any questions, they just want to make sure you're not on hospice about to die. They max those policies out at about 25 to 30,000. Some cases, very rare, 50,000. But you're only going to get a smaller amount of death benefit. But I mean, at that point, we're not trying to buy a house, or we're not trying to do this. We're just trying to make sure you have the ability to not burden your family. So to answer your question, that's the unique position I'm in. I have access to a way to get those people insured, and so that would mean there are possibilities out there for you.
Excellent. Yeah. One more question.
Yeah.
I have twin daughters, and they have decent careers. Like, what type of insurance do you suggest for them? They're in their mid-30s. No children, no husbands yet.
Well, I would use some of these more advanced strategies for them. Depending on what their income levels are, we can use certain policies, but let's put it, so they're how old?
34.
34. Let me just give you a scenario. Because...
And while you're looking for that, just on top of that, back in the day, parents were able to just take out policies on children and adult children. You can't do that anymore, can you? Without their permission, or can you?
Yeah. So if they're juveniles, you can do it. If they're adult children, yeah, you need their permission.
Let's do that. Yeah,
and adult meaning 18 or 21?
18.
I mean, because back in the day, like,
yeah, you could just,
it was just for those people well-being. So she's like, I know Harry's out there smoking crack. He gonna die.
Or if they weren't doing something that was harmful, just they weren't thinking about it.
Yeah,
like
sure,
my mother put insurance on everybody, and then when we got a certain age, she said, "Okay, I've had this policy for this amount of time, so now you take it over. You can keep it or you can lose it, but I've carried you." I think we were 21. You know what I mean? And you just, because you're not thinking about it. If we're not having seminars like this, I knew some stuff, but I did not know this amount of stuff about insurance. And when you say insurance, it's like, oh my God, that's so boring. I don't want to hear about it. I don't want to talk about it. But look at the wealth of information. So our parents, my mother died just, a few years ago. She was 91. She grew up knowing keep insurance. They borrowed against that insurance policy many years ago, but now it wasn't this. It may have always been this, but she didn't know beyond. I could take out some money if I needed to, but then I don't have an insurance policy. It was kind of like that. But yeah, you could put insurance on like literally anybody.
Wow.
Yeah. Well, what happens is that there's a suitability factor for insurance as well. So when they start looking at a person's income, if you make, let's say, $20,000 a year, but you want to apply for a $1 million life insurance policy, now what you have essentially done is made yourself worth more dead than alive, and that's out of your protection. Why they won't give you a policy like that? Because putting them on, because I have clients that call me,
Who's your,
and it
who's
could be an
beneficiary?
ex-husband. I want to put insurance on my ex-husband. I have one lady call and say her husband's in jail. She wants to put a policy on him in jail. We can't do that for a couple reasons, the jail, but for the other one with the ex-husband, well now, she,
Right.
you know,
Sit and done. I'm
something
gonna go
may,
kill you. so I
something
can
may
get that
happen
money.
to him.
Yeah.
So you definitely,
CSI.
you definitely have to get the permission, but I do have it to where, let's say your daughter or whatever, maybe not conscious on the scene, and you just tell her, hey, you know what, I want to get this policy on you. You're not going to pay for it. I'm going to pay for it. I'll do everything, because we do need a person's social. We do need driver's license, and most times they have to get that information from the person. But sometimes parents have it, or they have, you know, the spouses have it. But you just mention it to them, and then we can kind of run the process. But they really need to be in the know, and they probably should be a part of the process in order to, you know, get things going. But with people being busy, you know, I do things remotely, right? We can do things, DocuSigns and stuff like that. So they don't necessarily have to be in the initial conversation, but they do have to be aware of what's going on. Waylon, to your point about your daughters, this is just an example. I didn't want to. I wish I had the TV, but using the finance strategy that I was telling you about, this is on a 31-year-old, so it's not going to be the exact equivalent to your daughters, but the 5-year contribution for this plan for them would be $19,750. So over a 5-year period of time, that means they would be contributing $98,750. So let's just call it $100,000. The bank is putting in over a total of those 10 years, $269,590, which is a total of $368,340. So when we're thinking about a 401k, you know, you can put in 19.5, right? Or I'm sorry, 20,500. They just increased it this year. At their age, if you do that over a 10-year period of time, that's only 200,000 that's going in. Of course, there's going to be profit, but let's just say 200,000 over a 10-year period of time. Well, right now, 368,000 that's gone into that account, and 269 wasn't even yours. It was somebody else's. It was the bank's. At age 65, that's the arbitrary age that we use. This plan is projecting to pay out income tax free an annual income of $118,000 to them, based on that contribution. So already in year 1 of retirement, they would have basically essentially broken even and profited a little bit. So there's not many investments that you can, in year 1 of taking that income, you're already to the break-even point. And so after about 25 years of taking out the distributions, if they go from 65 to age 90, that would be $3 million that they would have extracted from that policy based on a $100,000 investment.
Shut up.
So when you ask the question, what should they be doing, these are the type of strategies that I would say that should be incorporated into their planning. They're probably not thinking about retirement at their age. Maybe they are. I'm just saying most people I come in contact with at that age aren't thinking about retirement. But this gives them, this policy here, based on the IRS guidelines 7702, gives them $1 million policy also. So they're going to have $1 million of death insurance, $1 million of living benefits, sick, injured, or ill, they'll have access to it, and then they'll get $118,000, or it's estimated $118,000 in terms of income at the age of 65. So with these types of strategies, the younger the better. It's not saying that the older individuals can't participate in it, but it's masterful for young people. It's just the mindset's usually not there, and sometimes the income's not there either. And so, very rarely do I get an opportunity to kind of promote this to the younger individuals, but it's out there.
We need to do a seminar.
I was already ahead of you.
Yeah, we need to but see, this is even when I was talking about legacy homes, and I'll kind of go back over that with you guys on a one-on-one, but the whole thing about building legacy is teaching this kind of stuff. Who teaches credit at 5, 4, 5? Not us. Not African Americans. Who teaches insurance? Even I watch my mom pay the insurance man who came every Saturday, blah, 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 blah. But it was not a taught thing.
No.
It was an expectation of, I have to pay the bills. But what bills are you paying? What are they for? What is it going to benefit? Okay, I'm gonna just have some funds to be able to get buried. Nobody's teaching, right, the education side of why we need insurance beyond death.
Right.
Which is why, remember when I even talked to you, I said, okay, Sid, I want you to talk about everything, but talk about the wealth building side, because this is the side that we have no clue about. At my age, at 55, hello, I should have known about this 20 years ago.
I sure would be in a better position.
Come on, right? We should not be getting to this stage where we're not prepared.
Right. Yeah.
We're prepared for death right? But even if we're not, we should know these things, and nobody's going to do it if we don't create forums and seminars and atmospheres for this. I said even about this seminar, if it's one person, that's one more person who gets it.
Yeah.
Right? So thank you.
What's the youngest age you can do a policy on the child?
As soon as they're born, day one.
So, like the Gerber babies.
Well, Gerber has a policy. I'm contracted with Gerber. I don't like to use them just because it's not that it's a bad policy. It's a whole life policy, and it's an older concept.
Yeah.
There's just more advanced things.
Because you lose that after a while. Is that the one?
No. That one, you'll find people to this day, your age, that will say, they got me this Gerber policy back when I was, No. And the good thing about one of the Gerber policies, the death benefit doubles at age 18. So if you get 10,000, it'll turn into 20,000. But what I do is I set it up to where, we started on a child or a grandchild, right? And we do it more like a college savings or like a bank account. Instead of doing a 529C plan, which only can be used for college stuff, I'll do it in this so that if they decide that they don't want to go to college or maybe something comes up, they'll have access to those funds. And then if I just told you that a 31-year-old has $118,000, which probably equates to maybe about two-ish million in that account by the time she turns 65, imagine what someone starting at zero is going to have. Obviously, you're not going to put in $2,000 a month for someone that's at age 0, so maybe you start at like $25 a month. You work your way up, and then when they turn 18, then you let them take over. But two big reasons that you would do something like that is not only the cash value, it beats putting it in a bank, but also it gives them a just add water life insurance policy. So when they start their family, they got life insurance.
And I said that because a lot of people, you get that stuff in the mail and they think it's nothing. And we need to teach it earlier. Because I know I wasn't taught about it. And I wish I had known.
$25 is actually overfunding it. So some of it's going into a cash accumulation bucket. So the real cost of that insurance is pennies on the dollar. But the price is going to stay the same as they get older. Whereas if you wait till you get older,
It costs more.
now it's $100 a month for that same policy.
Exactly.
Yeah. So.
So okay, I have a question. So when my my third child was born, she was born with a very, very rare disorder, and I tried to get insurance on her, and the insurance person said that I couldn't because she had pre-existing conditions. She died 3 months later, and then the insurance person came back and said, "Oh yeah, you could have gotten insurance on her."
Oh, wow.
So my question is similar, but in reverse. So as we've aged, of course, we have some things that, you said you could get underwriting for. Is that the same for infants?
Yeah, it's the same. So now certain conditions are just uninsurable for anybody beyond guaranteed issue. And then even guaranteed issue has sometimes age restrictions. So a lot of times, there is a company that does 0 to age 80, meaning it will cover infants on a guaranteed issue basis or even small children, but most companies, you gotta be like 50 years old to get the guaranteed issue. But certain conditions, it depends how it affects your mortality. So things like HIV is uninsurable. Cancer is not uninsurable, but there's different types of cancer. There's different treatments, there's different stages. And then time works on your side when you have certain conditions that you develop later on. If you're born with them, a little bit different, but if you develop them later on, it kind of helps you because they see, okay, this person hasn't died yet, so it's unregulated with whatever medication they're taking. Certain things like childhood diabetes, though, that's going to be one that's going to be very difficult to get approved.
That's awful.
Because diabetes, what it does is it basically puts stress and damages the organs. So the longer you have diabetes, the more damage is being done to the body. And so that's where time doesn't work in your favor. If you had diabetes within let's say 1 to 5 years, it's going to be better than if you had it for 10 to 15 years. If you got diabetes at age 50 versus having diabetes at age 20, it's going to be better for you at age 50. So little things like that.
So she had a disorder that it's known that the children don't live long. Like usually in the first year they die.
Okay, yeah. In that situation, there probably wouldn't have been even guaranteed issue. There are, even with guaranteed issue policies, they're graded policies, meaning in the first year, first 2 years, first 3 years, they may not pay out. They'll pay you back all of your premiums plus, let's say, 10%. So it's kind of like a savings plan for that point, for that very reason. They'll give it to you, and if you last past the 1 year to 2 year to 3 year, then now you'll get the full death benefit. Pay out. But in that type of situation, if it was known that it typically won't last long, then most likely it would have been an uninsurable event. Yeah, they're just not going to do it, the insurance companies,
I have one more.
yeah.
It's a little dark, but I was always led to believe that suicide didn't pay out.
After 2 years it does.
That's what I recently learned, and I don't think a lot of people know that.
I didn't know that.
Yeah, and I tell people, and my clients, matter of factly, I try to tell them, not so much like, because, I mean, it does sound a little bit dark, but there's a 2 year contestability period with all insurance companies. Basically means that if anything happens to you in the first 2 years, they can contest it. They'll do an investigation. Hey, you died from lung cancer. Well, you put on the application you were a non-smoker. Was there any fraud? Right? I just had a client, actually, so sad. She called me. I don't know why she would think that this would work, but her fiance was on life support. So she tried to get coverage on him while he was on life support, and I told her, no, I can't do that. Got to talking a little bit, and then found out she didn't have any insurance. So I got her covered for some insurance, right? I called her back to congratulate her on the approval. Maybe a week and a half, 2 weeks later, and I was like, I haven't been able to reach you. What's up? She's like, I didn't tell you. I have stage 4 cancer. And so I'm like, oh wow, okay, well, man, like you just found out? She was like, yeah, I was in the hospital with him. I neglected my own health. I went to the doctor after, he passed away or whatnot.
Wow.
Matter of fact, he passed away the next day after I got her approved. She texted me that night.
Wow.
And so the thing was the living benefits, right? I told you, blindness, cancer, this and this and that. So after talking to her, I'm like, well, man, I got you approved for this policy. It was to the point to where she couldn't really afford it. I paid her first month's premium for her so that she would lose this policy.
Yeah.
But the problem is, we made a claim, right?
That she didn't have.
Well, we made a claim for the cancer because I'm like, well, she got the policy. I called them and I said, she just got the policy. Did she make a claim this early? They said, yeah, fill out this paperwork. Come to find out, I think she had went to the doctor and had some type of symptoms prior.
It was in her record.
So what they ended up doing was refunding her back all her premiums and then just canceling the policy after they did that investigation. So I'm not gonna say that she knew, but she told me she didn't know. But
Right.
that's the 2-year contestability at work right there.
That's good to
So
know.
where they looked into that, they got records from the doctor, they matched up dates, and it didn't match up. And they even sent me a questionnaire, like, when did you know this and this and that?
Wow.
And what we said wasn't matching up to what they found, and she has no insurance now.
God bless her.
Wow.
So it's one of those things where you know what? And actually, no, I think she did have an insurance policy. And this is the sad part about it. The fact that she wasn't honest with me, I think she canceled that policy that she had before.
Or that it lapsed or something.
She was having problems paying for it. This was
It
the problem.
lapsed. It lapsed.
Come to find out, because that's why I had to pay her premium. But just little things like that. It was a 2-year contestability period, and the insurance company, they're in the business to make money.
Right.
So if they don't have to pay it out,
They
they
don't
don't
wanna
have to pay it out. They're gonna find every way to pay it out. But to go back to what you said, after 2 years, someone commits suicide, then
Yeah, I mean, her policy paid off. This really just happened last year, but we didn't know. But she did. She lived 2 years past the 2 years, and then she
did, yeah.
she went on with the plan.
Yeah, well, and that's the reason why is there are some people that will get life insurance purposely,
Knowing good and well.
knowing that they're gonna, because they want to take care of your family. I mean, it's a very noble thing to do, but
It's
that's
not
why
a good
the
exit
insurance-
plan. It's not a good exit plan.
Well, you know, that's that. So
But to those of us that are still here, it's
Yeah.
not. To the person who has done it,
Trust me, I
they've
know.
reached a point
It was
where,
there.
yeah.
mentally.
Well, that's it for
Thank
me.
you so much, Sid. Oh my God, that was amazing.
We're gonna take a few minutes break.